So we've gone through, like I said from the get-go, 3% growth was fantastic last year. It won't be repeated. In fact, the Bank of Canada is going to work towards not it being repeated. I won't say it in those words, but effectively this is what it means. And that's okay. That's okay. Like I said, potential growth rate, so the run rate in the economy is somewhere between 1.6 to 1.6 or 1.8%. We're expecting next year, and in fact, we're just about to revise it to above 2%. So we're still in this year, growth in economy is still going to be a little bit above potential growth rate. So still, I would argue, even though growth is going to slow down this year, it's still going to be a good year for the economy in Canada. Slower growth. Move on, next one. Now, and I just mentioned the bank is very well aware that the Canadian economy is now more sensitive to interest rates. And the reason being is that Canadians have accumulated a lot of debt. It's reason to monitor very closely. And there are many international organizations that are very worried about this. We are sort of worried, but we need to be a bit more, I guess, sophisticated, to look a bit more into the details than just the headline numbers. Now, here's the household debt to income ratio, which is probably the most frequently cited metric of household debt from, I would say, an aggregate perspective in an economy. We're not a big fan of this one, but it doesn't really matter which metric you want to look at in terms of household debt in Canada. Household debt is high. So move on to the next one. So what it means now, if the economy was to face like a full 1 percentage point increase in interest rates, now debt service payment, average debt service payments amongst households is going to be about double what it was about 15 years ago. So we are much more sensitive. I mean, it's going to impact our own finances, our household finances, much more today than 15 years ago. And that's like correcting for inflation. This is the impact of debt service payments in the context of higher interest rates. Now, Ontario, because household debt is higher than most provinces, Ontario would be even more sensitive than the Canadian average. So we estimate that a 1 percentage point increase in interest rate would result, on average, about $1,000 more per year per household in extra debt payment. So it won't be crushing in the sense that household income is going to grow as well. So it's going to provide some offset. We don't expect this to crush households if we were to see higher interest rate, but it's just going to make it a little bit more difficult for households. It's going to change the dynamics of the way they behave. They will probably be much more cautious, calculate a bit more when the kind of discretionary spending that they do. If we move on, so it means in our view, like retail sales that were very strong last year. I mentioned earlier about motor vehicle sales that were a record high last year. We're still expecting overall retail sales to grow this year and next, but at a slower rate than what we've seen in recent years. About roughly 5%. Last year was close to 8% growth. So still growing, but less so. It's more, I would stress more the dynamics, the kind of choices that a household will make in their spending, that when they're going to see their mortgage payments rising, they'll be a bit more cautious the way they spend. The housing market, we've seen for policy reasons, because of policy intervention, already there's a certain cool down in Ontario. We're expecting this to continue, partly because policy continues, like with the B20 and stress test is still having an effect, but also with rising interest rates. We've seen last few days some of the banks are raising their mortgage rates. This, at the margin, this is going to slow down demand for ownership. And so we do expect that we'll still view this as being a soft landing in the housing market. So a little bit of a slowdown in home resale activity this year and then stabilizing next year. What the bigger impact will be is with respect to price. We're not expecting prices to decline. This is a full year average over a full year average kind of basis, but we do expect that they will kind of flatten out. Will be very flat prices this year relative to last year after having a period of 3 years of very, very rapid growth. In my book, this is positive. We need a period of time when the housing prices are kind of lay low for a while. Because otherwise, I'm putting my hat, I have 2 teenagers at home, I'm thinking one day I'd like them to own a home. From an intergenerational perspective, if prices continue to rise at 15, 20, 25% a year, it's already unaffordable now, it's going to be even less. I think we will get into major intergenerational issues if prices continue. So a period of flat prices, I think, is a good thing. Even small declines, I don't think would be bad either.